Good morning and welcome to Words That Matter, Modern Day Book Club. I'm your host, Lee Smith. This morning we have a fascinating show. I hate to do this to you, viewers, but as it turns out, there are some things that there are some things that are bad, and some things that are getting worse. And I have to tell you, reading this book, I had really no idea how bad and how destructive the ESG, that is the environmental, social, and governance movement, actually is. Our author today has written a fascinating book. The title of the book is The Race to Zero: How ESG Investing Will Crater the Global Financial System. So even the title sounds pretty dire. It's a beautiful book, beautifully written, and so thoroughly researched. It's such an important book. The author, who we're so fortunate to have here this morning, is Professor Paul Tice. He's an adjunct professor of finance at New York University's Stern School of Business. Welcome, Paul. Thanks so much for being here with us today on Words That Matter.
It's great to be with you.
As I said, it's worse than I thought it was. I follow it a little bit, but I'd also heard, some people are backing off ESG, and ESG has been losing a lot of money. So actually, there are a lot of ESG officials at different corporations who are being fired from their positions. But the way that you describe it here in The Race to Zero is, it looks like no, actually ESG is on the march, and it's an inevitable fact right now, inexorable fact of the world of finance and our larger universe.
Yeah, I mean, I think some of the headlines recently that we're winning in terms of the pushback on ESG, I think are overstated. Maybe in the Charlie Sheen sense of winning, we're winning, but we're really not. It's still very strong forward momentum, and I think a lot of the focus up until now on ESG has been somewhat misplaced. There's been a lot of headlines around issues taking place in the corporate boardroom and at specific companies, and a lot of them are cultural issues. Not that they're not important, but I think a lot of people may be dismissing this as just another skirmish in the cultural wars going back over the last few decades. It's really important to focus on what's taking place in the financial markets and to keep the focus on climate change. That's the priority for the activists that are pushing this. That is the priority goal, no matter who you talk to. And the goal there is to defund oil and gas. It's not good enough just to direct more capital to renewable energy and clean alternatives. There also has to be a simultaneous defunding of oil and gas. So it's meant to force this transition. It's basically co-opting the private financial markets and the private sector to do the dirty work of government, because the activists that are pushing this are led by the United Nations, member governments, a whole global network of NGOs. So no, we're not winning. A lot of the headlines you see where people are backing off is just tactical. They're waiting for the regulators to come in and give them air cover, um, so they're not exposing their firm or their reputation. But when those regulations get put in place in this country, and it's already occurring in Europe, Europe is kind of giving us the glimpse of what's coming down the road. Uh, Once those regulations are in place, then everyone will be required to toe the line.
To what extent is this driven by true believers, and to what extent is it driven by people who know that they're going to profit from climate change infrastructure, from the climate change agenda? So what's the I guess who's really driving this movement?
Well, in the book, and one good thing about a book is it gives you, the time and the space to kind of go through the entire argument and history. You can trace back ESG to the 80s, really, when the climate change and the sustainable development programs started up at the United Nations. And really, ESG is the third leg of the stool. It's also led by the United Nations through their investor group that they formed back in 2006, the Principles for Responsible Investing. And every buy side firm on Wall Street is now a member of that virtue signaling group. So that's important to note. And that with that membership comes very strict requirements in terms of what they need to do around ESG ESG integration and company engagement. So this is primarily led by the United Nations. It's really designed to get control over the economy. In the book, I go through that. You can look at what's going on now in the financial markets with ESG is just the latest part of society to kind of fall to the progressive agenda. Free markets underpin capitalism, right? So it's basically being eroded from within. So those are the people. It's primarily government and supranational agencies that are driving this, and it's meant to capture more economic control over individuals and countries. But there are a lot of grifters along the way who are making money off of this. Al Gore, Michael Bloomberg would be good examples. You have all of the firms that have sprung up around Wall Street the last few years to kind of enable and facilitate this, right? To help people think about ESG. And there's just enough money in it to kind of grease the wheels. But when you look at ESG, it's not making money. It will never make money for the majority of investors on Wall Street, because there is no way that you can argue with a straight face that investing and choosing companies based on environmental, social, and governance factors, all of which are non-financial, are somehow magically going to lead to improve, financial performance down the road. And they never really define how long it takes to get down the road. It's always somewhere over the horizon, and there's no data that's been produced over the last several years that proves that an ESG invested portfolio leads to outperformance.
I'm fascinated to know how they were able to strong arm so much of Wall Street. I mean, what kind of leverage did they have on Wall Street to force Wall Street into ESG?
Well, it's interesting, and one of the books goes through what's happened since the financial crisis in 2008. And I think that created kind of a fertile ground for ESG to make inroads over the past decade. So coming right out of the crisis, all we heard during the first term, even the second term, from the Obama administration was that Wall Street wrecked Main Street, and all the blame was placed on the industry. And there's some truth to that, but I think the core reason that led to the problems in 2008 were driven by government policy around subprime lending. That was kind of the asset quality problem that spread the contagion through every asset class at the end of the day. But a lot of firms wanted to signal their virtue and kind of change their image, and so they were enticed into joining groups like the PRI, and hopefully capture a better image going forward. So everyone's been suckered into the trade because it would help burnish their image. And they were initially promised that, well, you could do ESG any way you like. You could focus on financially important ESG stuff. You could come up with your own approach, customize it, very bespoke, use whatever outside firm you want to. And so that made it easier for everyone to join. But what's happened now since 2015 is that the ESG program has become very prescriptive. So in 2015, we passed the Paris Agreement, obviously, and the UN also passed the 2030 Sustainable Development Goals. So now ESG is defined as aligning with both of those economic treaties, right? And so that's a changing of the rules of the game. But once you've joined this club, you can't really find the exit door. It calls into question your judgment, the fact that you were suckered into the trade originally. And, that's going to create a problem if you've got these firms managing your money. So people find it hard to back out, even though the requirements have gotten more onerous over the last few years. And that's the reason why you see a lot of firms on the buy side now focusing on net zero, because with climate change and sustainable development, it's all about climate change. And ESG, the priority goal is there. So it's not surprising that you see a lot of asset management firms, insurance companies, banks joining all of these other virtue signaling groups about net zero and getting to net zero emissions around their portfolio or their bank lending portfolio. So, the industry has been suckered into the trade. And as I mentioned before, there are ways to make money on the margin here. issuing ESG bonds or raising an ESG fund that charges higher fees. But again, for the most part, this is a negative for investors because it's layering in all of this extra overhead, and it's also an agenda that no one ever, agreed to. So you're doing this ex post, which is a huge fiduciary problem. So I think the problem with the industry and Wall Street in general is that they're very good to try and solve a near-term problem and figure out how to make money over the short term. But no one's really looked at the long term implications here. And the way sustainability works is, again, you become the target if you speak out. If you're a public company, that exposes you even more because they can show up at your headquarters or at your annual meeting. And there are many examples of that happening over the last few years. So it cuts down on dissent. It still has been surprising how many public CEOs haven't had the courage to defend their companies or their beliefs. And I would point to the energy sector as probably the worst example there. Oil and gas companies in the U.S. know that they are the prime target of this, and still they are trying to bargain with the other side, thinking that they'll be the last company standing in this process. And they haven't used their platform that they have to kind of speak out about the problems with the climate data and the science underlying all of this ESG push.
Well, that raises. You said that the energy companies think they'll be the last giant standing, and we talk about sustainability. Is this program, is the ESG program, sustainable? By which I mean, is Wall Street? They haven't sown the seeds for their own destruction, but have they allowed these different activists to come in and basically set traps all over the place? Can Wall Street survive ESG? Can the financial industry survive ESG?
Well, I mean, it won't be free market capitalism. It may be end stage capitalism. It won't be free financial markets. I mean, it's a legitimate question to ask. Having liquid two-sided markets require a difference of opinion because somebody needs to buy something that you're willing to sell at the agreed on price. So why is ESG, if it is an investment theory, which it's not, but how can you justify that everyone has to have the same opinion on all of these progressive tenets that are embedded in the ESG agenda? I mean, so markets unclear how they're going to function without having, a divergence of opinion. But it's basically you're going to be allocating capital and restricting market access. Um, you know, Over in Europe right now, if you look at how much bonds are being issued with a label, either green or sustainable or climate, whatever it is, it's an increasing percentage of the debt that's having that label. And we could get to that point where every bond that's issued in the market institutionally is going to have to come with that seal of approval, if you will, kind of like food inspection. So that would be the gatekeeper to prevent market access by firms and industries that are viewed as politically incorrect. And that starts with oil and gas. And then, once that is resolved, then it's going to move into other heavy industry. All the firms that either use a lot of fossil fuels in the process or have big asset footprints. Um, it's going to start with oil and gas, and then they're going to figure it out from there. But it's socialism, as we said at the outset, and it's a controlled market, and it's going to change the nature of a job in the industry, um, which is unfortunate, and which was another reason why I wrote this book. Was to kind of hopefully preserve what is a great career. And the 40 years that I worked on Wall Street, I enjoyed it throughout. And there were a lot of ups and downs. For every 4 or 6 years, you would have another crisis and a blow up. And 2008 was the worst. But it's going to fundamentally change the DNA and the types of people that will work on Wall Street, because this is not really analysis. Telling companies to provide more ESG disclosure, and then once they do that, go back to them and tell them to change their behavior because you don't like this or that metric. That's not analysis. I mean, if it were analysis, you would ask for disclosure and from that make an investment decision. That's 90 to 95% of what you need to make a decision. So clearly, if you've already set what the ESG agenda is, you don't really need people with analytical skills. You just need people to kind of, repeat what the goal is. And the other problem too is it will remove the agency of everyone working in the industry, because they're not going to be able to come at decisions around trades or investments from an objective perspective. They're going to have to resort to an outside opinion about, do I focus on climate change here? Is it emissions intensity or absolute emissions? And what about a fossil fuels company versus a company with a bad labor track record? So no, you need a referee for all of these ESG progressive tenets. It's the analogy I would use is, if you go out and play a round of golf, and on every stroke you have to call in a PGA referee, it's going to be a very long day and a very long round of golf. But that's effectively what's going to happen with ESG. You're removing the agency and the normal functioning of the markets and letting outside activists determine how that process is supposed to work.
Paul, I think calling it a PGA official, that's a nice way to put it, because as you were describing it, I'm thinking more like a political commissar. That's what that job is going to be like now, to make sure that everyone is fulfilling their political obligations under this particular type of, as you said, socialist regime. Paul, this is so important. Thank you so much for being here. We're going to take a quick break, less than a minute. Some of you are watching on YouTube. If you are watching on YouTube, make sure you make the jump to Epoch TV exclusively. Having a fantastic conversation here with Paul Tice about his new book, The Race to Zero: How ESG Investing Will Crater the Global Financial System. Such an important conversation. I've got a couple big questions to ask Paul when we come back. You don't want to miss any of this conversation. Make the jump. We'll see you in less than a minute.
Today's recession playbook basically has two big pieces to it. One of them is government spending. So you're going to ramp up government spending to prime the pump on the economy is the logic. And the other one is that you have to lower interest rates. So the Fed brings interest rates as close as possible to zero. So the idea is that companies are going to borrow a lot of money, they're going to invest, and then we're going to get the economy growing again. And what they did in the 1920 depression was kind of by accident the exact opposite. So they cut government spending and they raised interest rates. Within 1 year, we went from something that was much worse than the Depression to soaring economy. That then ushered in the roaring 20s. Okay, they had budget surpluses all through the 1920s. It was just astounding.